Your backtest is lying to you in 3 specific ways. And the worst one is in less than 1% of your trades. And the worst part is you won't actually see this on any of your charts. So I had Claude Code build the 5 most popular strategies on YouTube. Then I ran it against real tape. That's 1.7 billion ticks. 0 survived. This video will cover how to catch it before you trade it. I'm testing on ES futures data, but this can be applied to any strategy on any instrument. Every backtest tells you 3 lies: fit, fill, and fluke. 3 lies, 3 tests, and I wrote them all as code so you can point them to your own strategy and test against them. It's free and it's in the description. And by the end of this video, you'll know what each one is checking for. So here's the board of the strategies I tested. 0, 5. And here's the part that surprised me. Claude Code built every single one of these strategies perfectly, and not one failed because of bad code. Everyone failed on testing. So if you're worried about AI writing the proper code to test your strategy, that's already solved. Building is free now. Knowing whether it works is the expensive part. And these 5 are just crash test dummies. All public, published settings, nothing for sale. The thing I want you to leave with is the test rig. Because if you watch my last 2 videos, you already know a backtest can lie to you. This is the one where you find out whether yours does. And a quick bit of context and background on me. I'm an engineer and I've been trading futures for over 6 years now. I'm funded through prop firms and have multiple payouts. Right now, I have an algo live in the market that I'm validating. This is the pipeline that algo had to survive in order for me to be confident before it went live. So 1 experiment, 1 variable, the same 5 strategies, same entries, same stops, same targets on every single run. The only thing I change is the price I actually get filled at. So that's the whole variable. We're testing different fill models. So when the numbers change, and they're about to change a lot, there's only one place where that bias can be. Now this backtest ran from January 2020 all the way through July 26. So that's COVID, the 22 bear market, all of it. These tests ran through 7,300 trades. So nobody gets to tell me I picked an easy market. I created and made all these tests using 1 Claude Code subscription and all locally on my local system. It runs in about 2.5 minutes for the entire scoreboard. And you think these biases are just a YouTube problem? There's a paper in a peer-reviewed math journal with a section titled, "Is Backtest Overfitting a Fraud?" And that's a math journal asking it. So let me show you the mechanics behind everything. So to start, I put Claude Code to work building the strategies. VWAP bands, 2-period RSI, opening range breakout, MACD, and the gap fade. All these are published settings straight from the sources. I didn't actually tune anything, I just built what the video said to build. Claude Code built all these faster than I could describe. This should have been my first red flag. So now that I have the strategies, how do I actually test them? The first pass is exactly the way popular tools test them. And that's giving the backtest 3 separate advantages. The first one is you get in at the closing price of the signal bar, a price you can't know until the bar is actually closed. 2, we're assuming no commission, which means essentially you trade for free. 3, if the price touches your order, you get filled every time. And that's the default in most backtesting tools. And it was my own first pass too. It doesn't matter if you've only ever clicked Strategy Tester in TradingView. That's exactly who this is for. So let's call it what it is. This is the backtest with cheats turned on. I thought initially I might have been being too strict, but I ran it that way anyways. We entered at a price you couldn't have known, charge nothing, and fill on every touch. 3 of these strategies still lost money. I let them use these advantages, but they lost anyways. RSI was down 45K. Gap fade down to 44K. If you think about what this means, these didn't die from commission. These didn't die from bad fills. I hadn't even turned on fills yet. They lost with every advantage I could hand them. The issue was that there was never any edge there in the first place. The first lie is fit. So how do we test this? We let the backtest use every advantage. We turn commission to 0. We fill on every touch, at every signal close. And then we run this strategy with these advantages that the backtest can fake. If it still loses money, you're pretty much done here. There's nothing else to check. And it's easy. You could run that one tonight. All 3 of these tests are coded and in a GitHub repo I want to share with you. They ship running on random data that you can use it to test on today. And the reason for shipping it like this is you can actually see how the biases get caught, how they get created. Then once you point it at your own strategy, you can run these 3 tests to see if your strategy survives each one. And that's the whole point of this video. The link is in the description. All you have to do is drop in your email and I'll send you a link to download the code. Along with it, you'll get a newsletter about once a week where I break down each of these biases and new backtest strategies you can test on your own system. And that's the only thing I'm going to ask you for in this video. And that's test number 1 closed out. 3 of the strategies died at this point and I didn't test any further. The 2 that survive, I continued to test further to see if the edge actually existed. These 2 survivors are the opening range breakout, which was up 70 grand, and the VWAP reversion, which was up 9,500. Both were green, but remember, these were both with the advantages turned on. So to continue to test those 2, guessing isn't good enough anymore. I needed to know what actually traded. And for this, I needed the tape. 1.7 billion ticks. This is every trade in S&P futures in order for 6.5 years. Right now with Sierra Chart, all this is sitting locally on my system. I don't have to pay for a cloud bill, API paywalls, and nobody deciding what resolution of tick data I was allowed to have. And the first thing that the tape taught me is that having it isn't an advantage, it's a responsibility. My first set of bars were wrong, and it was a test that caught it, not my visual confirmation. The second thing is the bid and ask are sitting on every tick, so I can measure slippage instead of guessing at it. About a half a tick to get in, it's counted and not assumed. So starting with the VWAP reversion, it was up 9,500 with the advantages turned on. Once I paid commission and entered a price that I could actually enter at, it was up only 4,900. Then with realistic fills, it actually flipped from green to red and was down 5 grand. And that's before a single cent of slippage. Its entire profit was fills that never happened and more. The root of the issue was 3 things, and every bar-based backtest has all 3. The first is touch is not filled. Your order sits at a price and the market comes down to touch it. Backtests typically say it's filled, but reality says there is a queue of other participants at that price and you're at the back of it. Everyone in front gets filled and the market leaves without you. 2 is the stops gap. Say your stop is at 4,000. The last print before it is 4,000 and a quarter. And the next print after that is 3,998. Nothing ever traded at the number you have your stop at. Your backtest fills you there anyway because that's the number you typed. Reality fills you 2 points lower and those 2 points are yours. 3, and this is the quiet one. Say both your stop and your target both land inside the same bar. The bar doesn't record which one happened first. It can't. That information isn't there in most backtesting software. So what happens is it guesses, and you can guess who it guesses in favor of. So here's an example of one trade, the gap fade on January 26th of 23. The backtest books a $2,000 win at the target. Here's the tape. 7 ticks printed at my price and not one traded through it. Everyone resting there was in front of me, and that fill never happened. And the trade that won actually got stopped out. This is a $3,600 swing inside 25 milliseconds. And this isn't new. Finance named it in 1983. A resting limit order, quote, provides a free option to trade. So when you put in a limit order out there, you've written an option for free. And the market only exercises it when the news is bad. On the days you would have won, it walks straight past you. Your backtest thinks this is a fill. And here's why you'll never catch this by eyeballing an equity curve. 55 trades. Out of 7,300, under 1% of the sample carries 100% of the damage. So bias 2 is the fill. And how do you test this? Well, you can interrogate it. Ask your backtest one question. When my stop and my target land inside the same bar, how do you decide which one hits first? If it can't answer, it's guessing. And it's typically guessing in your favor. And the way you check for it is the count. Take your winners and ask how many of them needed a fill at a price the market only touched. If it's under 1%, don't relax. That's exactly what was here. So that's test number 2. And if you want to run this against your own strategy, it's included in the same link I mentioned earlier, so you can download it and run it on your own. And I want to be straight with you. I did all these tests intentionally on the 5 strategies I found. I had the right data, the right tools, and the right background to perform all these tests without errors. But during the process, it was interesting because I still found and introduced multiple biases in the backtest system. 442 phantom stop gaps would have made a great thumbnail. That's until I actually looked at the stop values that the backtest was testing on. The stops were at tenths of a price instead of a quarter of a price that tick values actually trade in. So those prices didn't exist and you couldn't actually put a stop there. Once I rounded it and put it at a real tick value, those 442 stop gaps turned to 0. That dramatic number was my own bug, and I knew what I was doing. And also during this process, my code dropped 118 trades. It printed results that looked normal with great screenshots and great equity curves. But when I ran the counter tests and the validation test, these vanished. None of these typically get caught by looking at the equity curves after your backtest is ran. And unless you know code and investigate each line personally, using AI can fall into these traps. And that's why coding backtests with AI can lull you into a false sense of security. This is why you need to run validation tests and checks on your own code to make sure your backtest results are truthful. And for me, I'm speaking from experience. As I was developing my algo that is live in the market, I had several strategies and trades that looked amazing on paper, and I even got as far as making them execute live in the market when I was paper trading them. But when I was getting results and live data from the market, my results were not matching my backtests. So I had to dig into why, and it was because my backtests had biases in it that invalidated the strategy. So I had to kill several strategies because of this process, and I wasted tons of hours because I didn't run the proper tests until I developed the system to check and validate against what should actually be happening in the backtest. So after all this, when applied to the same 5 strategies, one test is still standing, and that's the opening range breakout. The opening range breakout didn't just scrape through. It looked like it took every test and succeeded. I had real entries, real commission, and it was still up 63,000. With truthful fills and all 3 traps on, it was up 51,000. I measured slippage on top of that, and the final value was 34,000. So this means the setup generates $20.63 a trade. This is real money on one contract on a strategy that Claude Code built in an afternoon. And this is where every video about this stuff I feel like ends. With one survivor, one thing lives, everyone says you can run this strategy, generate infinite money, and then roll the credits. But I asked the question that no one asks. Does a simple buy and hold strategy beat this strategy? So the result of this, in the same window with no strategy, no signals, and no screen time to find your edge, it ended up being up $212,000. The opening range breakout strategy made a sixth of that, and it took 1,600 trades to do it. And here's the part that stings. Your backtest already told you that. TradingView prints a buy and hold return right under your equity curve. And it was sitting there the whole time, just everyone scrolls past it. So at this point, I had a suspicion and wanted to run one test to settle it, and that's drift control. Drift control goes long exactly at the same moments the opening range breakout did. Exit at exactly the same time and ignore the signal completely. Just be long. This separates 2 things a strategy can actually be paid for, which is showing up and executing at the right time or actually knowing something. If the signal knows something, it has to beat it with the version that doesn't. That earns $51.62 a trade. Opening range breakout longs earn $51.12. This is 50 cents apart. So at the end of the day, it's not a strategy. It was a long position with extra steps. So bias 3 is the fluke. How do you test this? You take the signal away. Same times in, same times out, with no signal. Just beat in the market. If you can't beat that, you don't have a strategy. You just have market drift. And this step takes about 10 minutes to run on anything you're already trading. So here's the final scoreboard, 0 of 5. Claude Code built all of them perfectly, which is exactly the point. When building them is free, the build is worth nothing. So if you don't have an edge, none of this works. The edge moves up the stack, and you have to know what to test. So in a nutshell, here's 3 biases. Fit, you let the backtest use any advantage and see if it still loses. And fill, you interrogate your backtest and count the wins that needed a price the market only touched. Lastly, fluke, you take the signal away and see if doing nothing beats it. That's the whole gauntlet. Run it on your own strategies before you put money behind it, not after. And the algo I developed running live isn't proof this stuff can't work. It's proof that you can develop these tests, pass the gauntlet, and put things live in the market. So go run these tests on whatever strategy you have right now that you're trying to backtest and validate. Test 3 specifically is great because you have the same times in, same times out, just without the signal. It's also included in the code and takes about 10 minutes to run, and it's the most likely to ruin your night. And I genuinely want to know what you find because I've been wrong on my own, and it's not fun to do it in a silo. So tell me in the comments, did yours die to fit, fill, or fluke? Also, if you have something you want me to put through the gauntlet, comment below. I'm thinking ICT, smart money concepts, or some other popular strategies. Anything interesting will get put through the gauntlet. So check out the code and the newsletter in the description below. My name is Drew. Thanks for watching.